Hello and welcome to the latest episode of the Smart Divorce podcast. And I am delighted to be joined today by Matt from ETC Tax. Matt is a tax advisor. I'm going to let him introduce himself properly and tell us a bit about where his expertise lies. So hi Matt, thanks for joining me.
Hi.
Do you want to introduce yourself and tell us a bit about you?
Yes, of course, yeah. So as Tamsin mentioned, I'm an associate director here at ETC Tax. We're a specialist tax boutique supporting both individuals and professional advisors on complex tax matters. So we really like to get into the more complex kind of stuff. As for my background, I actually started my tax career in one of HMRC's call centres. Started there when I was only 18, straight out of college. Learned a little bit about tax there. Moved over to a firm in Altrincham, who are no longer actually around. They were taken over quite recently. And was there for 8 years. Did my exams. Decided to move on into Manchester to one of the big top 20 firms. Learned a bit more about tax over there. Then was given the opportunity to head up a department for a smaller firm in central Manchester, where I quickly became the head of private client tax there, leading the private client tax function. So that's really where my background is. It's in people and their problems rather than corporates and limited companies and so on.
Perfect, which funnily enough fits absolutely ideally into us. So we quite often get questions about tax in the course of our work as financial planners working in divorce. And I think lots of people get confused about the different taxes and also slightly confused about who does what and when they might need a tax advisor. So we're going to cover all that today. But if we start off with capital gains tax, because there's been some massive changes in terms of law around divorce in terms of this tax. So do you want to start by telling us what the law was in terms of CGT and how it's changed, and so what the law is now?
Sure, yeah. I guess whenever anyone's going through a divorce, probably one of the last things that they're thinking about is a tax liability. But it's very important to be aware of all the factors, particularly the financial factors around a divorce, and tax is certainly one of those things. The law changed, as you mentioned earlier, on the 6th of April 2023. Prior to that, the law was that spouses basically have what's called a nil gain, nil loss exemption. So if you're married, you can pass assets between yourself and your spouse tax free without any issues at all. However, when you're going through a divorce process, in the year prior to the recent changes, in the year of separation, that nil gain, nil loss exemption still applied. So if you were going to try and be as tax planning as possible around your divorce, you would start your divorce on the 6th of April, because that then would have given you until the 5th of April to sort out transferring of assets. Now, once you get outside of the year of separation, and the legislation around it is that you have to have lived with your spouse at some point in the tax year in order to benefit from nil gain, nil loss exemption. So once you've moved out, that's obviously once you then move into the new tax year, if you don't move back in again, then that exemption doesn't apply. So that's a big issue when it comes to a divorce settlement. If there's a number of, say, properties or assets that you share out, as part of that process, if you've not been able to do that within that initial period of exemption, then there could be capital gains tax consequences for that. The reason for that is that people who are married are connected for tax purposes. So there's a statutory definition of what connected persons are, but it's usually your mother, father, siblings, children, and spouses. The reason that's important is that when you transfer assets between connected persons, you're deemed to be doing so at market value of whatever that asset is. So even if there's no actual money changing hands, you're deemed to be selling it to your spouse at its market value. If that's an asset which has gone up in value significantly over the period of time of ownership, then we'd be looking at capital gains on the difference between that market value and the acquisition cost.
This legislation always seemed massively unfair because you've not got a 12-month period. You've got however much of the tax year happens to be left when you separate. And like you say, if you decide to separate on the 6th of April, all well and good, you've got 12 months, although actually getting to a financial settlement in 12 months is pushing it. But, you know, if you separate in March, Gordon Bennett, you've had it, haven't you? There's really no chance that you're likely to get everything done and dusted. So, okay, so that's where the law was. So what's changed? Where are we now?
So since 6th of April 2023, transfers between spouses has been extended to the 3 tax years following the year of separation. So that gives you at least 3 years, possibly as much as nearly 4 years to sort out your affairs. That nil gain, nil loss exemption will apply in that period of time. In addition to that, and to make things even more, I guess, flexible, if the assets are being split up via a court order, there's no time limit on that court order. So your divorce could take 10 years to go through if it's going through the courts. If assets are transferred via a court order, then the nil gain, nil loss exemption still applies.
Awesome. So, I mean, I think it's no brainer to get a court order when you're getting divorced anyway. Like, get everything in writing, get it all sealed by the court and legally stamped. But even more reason too, if it means that there's no capital gains. However, as you mentioned before, when you were describing to us what capital gains actually are and how the no gain, no loss works, we're not saying there's no capital gains tax payable at any point. We're just saying that there's no capital gains tax payable on the transfer at the point of divorce. Have I got that right?
Correct. Yeah. So the way that it works is that the receiving spouse, whatever the asset is, let's, for example, use a property as an example. If a property is transferred from one spouse to the other, the receiving spouse is deemed to receive that asset at its original base cost. So it doesn't matter what the value of that asset is under the nil gain, nil loss provisions. It's the original base cost. So in an example where a property it may be worth £500,000 at the time it's transferred over, but if it was purchased for, say, £200,000, the receiving spouse's base cost for capital gains purposes is the £200,000. So if that spouse then goes and sells that property for, say, £550,000 in the future, they will pay capital gains on the difference between the 550 and the 200 original base cost. Okay.
So when we're thinking about the true value of the asset that we're transferring across to our spouse, even though the capital gains tax isn't payable, it needs to be considered, and we need to understand that actually the value is the value less this capital gains tax that would be payable on the transfer of that. Would that be what you would say?
Yeah, it is, but it's naturally difficult to quantify because capital gains tax has differing rates. If you're a basic rate taxpayer, you have some of your gains could be taxable. If we're talking about property, they could be taxable at 18%. Some of them could be at 28%. It's very possible that between the date in which those assets are transferred over and the date in which it sells, the government may well have changed those rates. So while it's important to factor that into any divorce agreement that's occurring, it's quite difficult to quantify what that figure is going to be because there's a lot of determining factors.
Okay. So this might be $1 million question next. So in those circumstances, obviously getting tax advice from a tax advisor is going to be vitally important. Would you normally look at the position that the spouses were in at that point? So if you were looking at husband giving or transferring a property to wife, you would look at her circumstances at that time.
Yeah, certainly. So we could give an estimate based on current law, of what the capital gains tax liability would be, assuming everything's the same. And all we would really need to do to take that into account is to know what that property was purchased for in the first place, to get an understanding of what the wife's income is, because as I say, it is relevant. And do a best estimate. As you will have seen, if you pay attention to capital gains tax, there have been a number of changes recently, particularly to do with the amount that you could earn without paying any capital gains tax. Previously, it was 12,300. This current tax year we're in is 6,000, and it's going down to 3,000 from April next year. So that's quite a fairly significant reduction in those allowances, which means there's going to be more and more things that come into the scope of CGT that didn't previously.
That's a chunky old difference, isn't it? So when we're talking about income under which you don't have to pay capital gains tax, this is gains, rather than income. Earned income. Okay, so that's a huge shift from kind of best part of 13 grand to 3 grand. That's going to affect a lot more people as well. So I think getting the right advice is really going to be important. I think the question that is most commonly asked about capital gains tax when people are going through divorce is around the marital home. Because this is the thing that I was going to say everybody has. That's not quite accurate, but a large majority of people in this country own their own property, and on divorce this is a massive issue. So what's going to happen in terms of capital gains tax around the property? So do you want to give us an overview of this?
Sure. So you're quite right. The family home is often a very large point of contention, and as mentioned before the changes in April 2023, the family home was effectively that had the same treatment as all the other assets, in the sense that the nil gain nil loss provision only applied for the year of separation. There was, however, and still is technically, it's still within the legislation, an additional bit of relief for the departing spouse, which applied only in circumstances where the property was being transferred to the occupying spouse. So in the case where let's just suppose that the property is being sold, first and foremost. If it's, instead of it being transferred from one to the other, if it's being sold, then the departing spouse would likely pay capital gains tax on any period that he wasn't, or she wasn't, I should say, they weren't occupying the property. With capital gains tax, the main relief is main residence relief, or principal private residence relief. It's had a few names over the years. Which is a 100% relief against capital gains tax if you purchase a property, occupy it as your only and main residence, and then sell it. As part of the main residence rules, you can still get relief for the final 9 months of ownership of that property, even if you weren't living there. You have to have lived there at some point in order to qualify for that, but you don't have to have been living there at the time. Now, if the departing spouse leaves the property and it is sold within that 9-month period, no issue. If, however, it is a long-standing divorce and there's a number of years in which the departing spouse has been out of that property, well then, in an example where, let's suppose they bought the property 10 years ago, the departing spouse moved out after 5 years, and the property was sold after 10 years of ownership, only 50% of any gain for the departing spouse would be covered by that relief. The occupying spouse would get 100% relief because they'd been living there. Now, that if there was a transfer from instead of, so that's the circumstance, or that was, I should say, the circumstances if the property was to be sold. If the property was to be transferred to the occupying spouse, there was an additional provision, as I alluded to earlier, whereby, providing A, there was a divorce, B, during the period of the departing spouse's absence, the occupying spouse remained there as their main residence, so providing they still live there, and the departing spouse hadn't acquired a new main residence, they could still apply for main residence relief for that period that they were not actually occupying the property. So there's some provision in there for when the property is being transferred from one spouse to the other. Doesn't apply at all, or didn't apply, I should say, at all, if the property was sold. Since April 23, the rules have effectively become much more aligned. So the rules do apply if there is a sale. Same rules apply. Providing the departing spouse hasn't acquired a new main residence or elected for a new main residence, then even if there is a sale to a third party, they would get relief for that period. So that's a fairly big change. And again, it widens the time period from departing to solution and solves any tax issues that have arisen because of that.
Yeah.
In addition, actually, one thing which is not mentioned very often, but in some cases, spouses who have departed and transferred the asset to the remaining spouse actually retain an interest in that property if it's sold in the future. And again, prior to April 23, any gain, I suppose, or profits received from a future sale would be subject to CGT. Again, that is a change whereby that is still also treated as a nil gain, nil loss acquisition for the departing spouse. So big changes in relation to the departing spouse, but mostly linked to the sale to a third party as opposed to the transfer to a departing spouse.
Fabulous. That, I think I've got my head around that.
Yeah, quite a lot of information. I appreciate.
So I'm just thinking in terms of, we talked about the transfer of the property with one spouse retaining an interest.
Mm-hmm.
I know there are people who they both retain the ownership because of mortgage circumstances, etc. But there's a measure order in place that the property won't be sold until youngest child's 18 or whatever.
Mm-hmm.
Does that class under that rule that you just explained?
Yes, it should do, yeah, because the departing spouse has retained that interest in the property.
Okay, so it doesn't have to be that the property is fully transferred across to the other person at the point of the order being made. Okay, perfect, brilliant, that's great. Have we wrapped up CGT?
I think, yeah, pretty much. That there's, as I say, the only the main point was that the rules around main residence relief on those transfers applies more to sale as well as transfer to the spouse, which is a big point. So yeah, I think we're pretty much covered on that.
Excellent. Just one question, I think, just because this is a cause for debate all the time. Is there as far as tax is concerned, because I know the law is a whole law unto itself, but as far as tax is concerned, the date of separation, is that the date somebody leaves the family home?
Yes, it is usually, yeah.
Okay, perfect. So it doesn't necessarily mean the date that one of them starts sleeping on the sofa, or
no, because as mentioned, within the tax legislation, it's to do with whether the spouses have lived together in the tax year.
Sure.
So if they're still living together, they might have separated sort of informally and one's been sleeping on the couch for a year. It's when they actually leave that I guess the provisions of the nil gain nil loss start. They do still start because there is still a deadline if not court ordered. But yeah, there's a lot more time now, whereas there was quite a restricted time before.
Okay, that's really useful, thank you. And the next tax we're going to tackle today is inheritance tax. So inheritance tax is about when somebody dies. So
Yes.
talk to me about how divorce impacts inheritance tax.
There isn't an awful lot, to be honest, to be too concerned about. When spouses are when spouses are married, any transfers of assets, similarly to capital gains tax, any transfer of assets is exempt from IHT. So you can pass assets between spouses without having to worry about IHT, unless you are a UK domiciled spouse and you are transferring assets to a non-UK domiciled spouse. Now, that might be a term that people might not be too familiar with, and in order to keep it as simple as possible, domicile generally is where you're from, and you usually inherit your domicile from your father. That's as simple as I can make it.
Okay.
The restriction on that is that you can only gift assets up to the available nil rate band that you have, which for everybody is £325,000. If you were to transfer more than £325,000 of value from a UK domiciled spouse to a non-UK domiciled spouse, there would be lifetime inheritance tax payable on that transfer. So that's quite an important point. That, without wanting to get too technical, there are circumstances where the non-domiciled UK spouse can apply to be considered domiciled for the purposes of asset transfers for IHT. But yeah, that's probably a whole other webinar.
That sounds very complicated. Okay, so because domicile is another term that's defined differently in tax legislation and under law. So
yeah, it's not actually at all detailed in the tax legislation. There's no definition of it. It's a common law definition, domicile, which
wow.
Yeah, essentially, but yeah, to keep it as simple as possible, it's basically where you're from or where your father was from.
Okay, so if I'm from the UK, but my father was from China,
yeah,
I would be domiciled in China.
Naturally domiciled in China. Yes, you can acquire a domicile of choice by effectively cutting ties with the country of your origin, if you like, and setting up home in another country. If you've actually been in the UK for a certain amount of time, you are deemed to be UK domicile, even if you're not. So you can actually become UK domicile, deemed domicile, once you've been in the UK for an extended period of time.
Okay, so at that point, those transfers might be acceptable.
They would then become exempt. Yeah, if you were deemed domicile, they'd be exempt, and you are. That exemption applies right up until the divorce is finalised. I think it's decree absolute once it's completed.
Yeah, that's the final order now, but yeah. It's all changed since no fault divorce, but yeah, okay, that makes sense. So I think
a very final point on that is if assets were transferred after the final order, then from one UK domiciled spouse to another, they would be considered a potentially exempt transfer for inheritance tax, which means they're not subject to inheritance tax at the point of the transfer, but the gifting spouse has to survive for 7 years in order for that value to escape their estate.
Okay, so wrap them in cotton wool for 7 years.
Final point. Final point I would just say is that getting a divorce doesn't revoke a pre-existing will. So if you don't want your spouse to be in your will, I'd suggest getting a new will.
Absolutely. And our previous episode, you can go and listen to Michelle Tong from Private Client Solicitors talking all about wills and lasting powers of attorney. So lots of information there. Yeah, massively appreciate that. That is good advice. And then another tax that we haven't yet considered is income tax. So again, how is income tax going to impact our divorce? Oh, not our divorce. You and me aren't married yet. So.
No. No, it's not directly impacted necessarily, in the sense that there's nothing really that's going on in the divorce that's going to lead to an immediate charge to income tax. The transfer of assets between spouses is not subject to income tax. However, a spouse may receive as part of a divorce settlement, say, let's use a property again, or perhaps a share portfolio, which generates income. So if an income generating asset is passed from one spouse to another, the recipient spouse will become liable to income tax on the income that is generated from that asset. If the spouse hasn't, for example, had that type of income before, they may need to complete a self-assessment tax return in order to declare that income. So while it's not yet necessarily directly impacted by the divorce proceedings, it's more of a, I guess, an after consideration once everything's been distributed.
Yeah, and that's really good advice, because I've certainly had clients who were joint owners of an investment property, so a property that was rented out. They've never needed to do self-assessment forms because they perhaps didn't have any income, and the rental income, their share of the rental income, was falling within the personal allowance. But actually, if the whole property is then transferred to them and they're receiving double the income that they were before, there's every chance that they then need to declare this.
Yeah, it's entirely possible.
Yeah.
I suppose another thing just to think about in terms of an income tax thing is to do with maintenance payments. The receipt of maintenance payments is not taxable on the recipient.
Sure.
However, from the spouse who is required to pay maintenance, that maintenance payment must come from net income. So if you are required to make maintenance payments, that will factor into your personal tax planning in order to make sure you're extracting income from wherever your income sources are in a most tax efficient manner in order to pay those maintenance payments.
That's useful information, because quite often I have come across business owner spouses who would very much like to pay their maintenance via creating a salary from their own firm.
Yeah.
And my view is always, well, that's not a maintenance payment, that's a salary, and it needs to be paid for a job of work. Would you agree with that?
Yeah, maintenance payments are due from someone's net income. So I've seen something fairly similar where payments were made directly from the owner managed business company to the former wife in this case. But those payments were just effectively considered to be borrowings by the director. So they're effectively borrowing the money from their company to give to the former wife, but those borrowings have to be repaid with taxable income. So at some point, the tax is going to would have to have been paid on those payments by the director by way of drawing taxable income.
Okay. So if you want to think about the most tax efficient way to draw the net income, or the income after tax, to pay that maintenance figure, then tax advice is going to be pretty essential, I would have thought.
Absolutely, yeah.
Okay. A question just popped into my head, and I really should know the answer to this, but it's flummoxing me. If I've got an ISA and I want to and that my ISA is going to be transferred to my spouse on divorce as part of the settlement, that stops being an ISA on the transfer, doesn't it?
Yes, I believe so. Yeah, yeah.
Yeah.
It's not.
That's what I thought, but I was suddenly like, that doesn't seem quite right. But
I believe the recipient spouse would need to set up their own ISA and put the funds into that. The spouse passing the ISA over, ISAs are tax-free essentially. So particularly if it's stocks and shares ISA, you're required to liquidate the stocks in order to get the cash. There's no personal income tax on that process.
Okay. Again, that's worth thinking about. If it's in an ISA and you think, oh well, that's a benefit, I'll get this tax-free wrapper around that when I get hold of it. Actually, that's not the case on the transfer, unless you put it into your own ISA and have sufficient allowance available. I guess it is worth us just touching on the available personal allowances for tax, because I think I think they're quite complicated. So let's start it. Let's go in the order that we've
Do you want
worked
to
our way
tell
through
me what
this.
you know?
No, not at all. I want you to tell them.
Okay.
So
So,
capital gains tax. So personal allowances currently.
well, annual exemption is the correct term
Annual
for
exemption.
yeah,
Okay.
personal allowances to income tax. So, capital gains annual exemption is currently £6,000. That's for the tax year 22 to 23. Sorry, 23 to 24.
That's because you're doing tax returns at the moment, isn't
Yeah,
it?
yeah.
Okay, so 23, 24, 6,000.
Yeah.
From April the 6th, 2024, that reduces to
3,000.
there. Right. Okay. And if there is capital gains tax to pay, if it's a property, the percentages are much higher than if it's an investment, stocks and shares, etc.
Yes. So gains within the basic rate band is the term, are taxable at 18% if it's UK residential property. Gains within the higher rate band are at 28%. What that means is if you had income where you were a basic rate taxpayer, which is, we'll come on to this in more detail. Essentially, if you earn less than 50,000, give or take, some of your gains will fall within your basic rate band and be taxable at 18%, and anything then over that would be taxable at 28%.
Okay, and if it's an investment,
yeah, for anything other than UK residential property and something called carried interest, which applies to hedge fund managers, it's 10% on gains within the basic rate band and 20% on higher rate gains.
Okay, that's quite a big difference, isn't it, between residential property and non-residential property? Okay, right. Inheritance tax. So we talked about 325,000 nil rate band. There's an extra bit.
There is. If you're so if you're passing the family home to your lineal descendants and your estate is not worth more than 2.35 million, you may be entitled to something called the residence nil rate band, which is an additional 175k on top of the 325.
Okay, so, what was that clever phrase? Lineal
descendants to your kids, basically. Yeah.
Awesome.
So if you have a husband and wife, for example, if husband passes away and passes all his assets to the wife, his nil rate band and residence nil rate band also pass to the wife. If then when she passes away, she passes the family home to their children, then effectively she would have up to £1 million of nil rate band before she would pay inheritance tax.
Brilliant. So if we've got when you're married, you could potentially have up to £1 million between you. And this sounds fairly straightforward to say, but actually when you think about it, it is a huge difference. You've actually, when you divorce, you only have 500,000 each. And if you've got two homes, actually that can soon swallow that up in certainly in the UK at the moment.
The residence nil rate ban was introduced because people were living in their family homes for 40 and 50 years, and because of the increase in property values in the UK over the past 20 years, people were finding that they were simply wanting to pass the family home on to their children, and the children were being hit with very large capital gain inheritance tax bills.
Sure. Yeah. So certainly come across cases like that. Okay, and then we moved on to income tax. So just very briefly, and because income tax can get massively complicated, can't it? So
there's lots of different bits and
there's lots of bits.
Yeah,
absolutely. So if we start with earned income.
Yeah. So your personal allowance for income tax is £12,570. That's you can earn tax free. Now that will be reduced potentially all the way down to zero if your taxable income exceeds £125,140 per year. So you might actually be entitled to no personal allowance if you're a high earner. But keeping it simple, 12,570 tax free. The next 37,700 is taxable at 20%. Then from 50,270, which is the two added together, up to 125,000 140 is technically taxable at 40%. And I'll explain what I mean by technically in a minute.
Yeah.
Anything over 125,140 is taxable at 45%.
Okay.
The technically bit applies to the income that you earn between 100,000 and 125,140. Now, those of you who are good at maths will know that 25,140 is 15,270. Sorry, 12,570 times 2. There's a quite almost an unknown tax band in the UK between 100,000 and 125 of 60%. And the reason for that is that as you earn over 100,000, as I mentioned before, you start to lose your tax-free personal allowance. So for every pound you earn, you pay 40% tax, but you also lose 12,000, well, £1 of your allowance, which means that pound is now becoming taxable at an additional 20%. So the effective rate of those tried together is a rate of 60%. So in reality, it's 20, 40, 60, 45.
Terrifying that over 100,000, and it's also terrifying how few people are aware of it if they're in those earnings. And I can imagine that many people will not have a huge amount of sympathy for those people, but it will become more and more achievable for people to be earning that amount as we see people's earnings going up and up.
A tax planning perspective,
Absolutely.
in that if you are in that bracket and were to make pension contributions, you would get 60% tax relief on your pension contributions.
Yeah, absolutely, which is huge, isn't it? And well worth doing. Brilliant. We're coming to the end of our time together. Anything that I should have asked you that I haven't, or anything that you want to say to round up?
I think we've pretty much covered the important changes, and as you mentioned, when going through a divorce, I imagine that tax is very low on the priorities list, but it should be fairly high on the priorities list. It all forms part of the divorce settlement. At the end of the day, the idea is that you distribute the assets in a fair and just and reasonable way. Well, that wouldn't be the case if you received something that you then later paid a big, chunky amount of tax on. So it is very, very important. At ETC, we're specialists in tax. We deal with these types of matters on a very regular basis, and I myself have written a number of expert witness reports for court cases. So if you find yourself in those circumstances where you need specialist tax support, we'd be delighted to support you.
Wonderful. And Matt's contact details are in the show notes for you to be able to get hold of him directly. And I think, as he said, if you've got any assets that you're likely to pay capital gains tax on, getting tax advice early on in the divorce process is going to be absolutely paramount to avoid having to run and find an emergency tax advisor at short notice, which is never a good plan.
Yeah, the worst thing you could do is do it and then ask for help afterwards, because once you've done something, all we can do is tell you what you've done, as opposed to help you plan for something that's about to happen. Absolutely.
Great advice. Matt, thank you for joining me today. That's been really useful and relatively straightforward and easy to understand, which is good news. So many thanks for joining me. Many thanks to you for listening and watching, and do hope you'll join us for our next episode.